The world of investing can seem overwhelming, especially when faced with a plethora of numbers and metrics. However, understanding some key financial ratios can simplify your decision-making process and boost your investment prowess. Today, we'll explore these essential ratios and explain why every investor should be familiar with them. What are financial ratios? Financial ratios are mathematical calculations using figures mainly from a company's financial statements. They provide a way to evaluate the company's performance, financial situation, and investment potential. Price to earnings, PE, ratio. 1. Definition: this ratio measures the price you pay for each dollar of earnings. 2. Formula: market price per share, earnings per share, EPS. 3. Example: if a company's stock is trading at $100 and its EPS is $5, the PE ratio is 20. 4. Interpretation: a high PE suggests that investors expect higher earnings growth in the future compared to companies with a lower PE. Price to book, PB, ratio. 1. Definition: compares a company's market capitalization to its book value. 2. Formula: market price per share, book value per share. 3. Example: if a stock trades at $50 and the book value per share is $25, the PB ratio is 2. 4. Interpretation: a lower PB ratio could suggest that the stock is undervalued, but it could also indicate underlying problems. Debt to equity ratio. 1. Definition: indicates the proportion of equity and debt the company uses to finance its assets. 2. Formula: total liabilities, shareholders' equity. 3. Example: if total liabilities are $500,000 and shareholders' equity is $250,000, the debt to equity ratio is 2. 4. Interpretation: a high ratio suggests higher risk, but it also can indicate that a company is aggressively financing its growth with debt. Current ratio. 1. Definition: measures a company's ability to cover its short-term obligations with its short-term assets. 2. Formula: current assets, current liabilities. 3. Example: if current assets are $1 million and current liabilities are $500,000, the current ratio is 2. 4. Interpretation: a current ratio above 1 indicates that the company can pay off its obligations if they came due at that point. Return on equity, ROE. 1. Definition: measures the profitability of a company relative to its equity. 2. Formula: net income, shareholders' equity. 3. Example: if net income is $100,000 and shareholders' equity is $500,000, the ROE is 20%. 4. Interpretation: a higher ROE indicates the company is effective at generating profit. Dividend yield. 1. Definition: shows how much a company returns in dividends each year relative to its stock price. 2. Formula: annual dividends per share, price per share. 3. Example: if a company's annual dividend is $2 and the stock price is $50, the dividend yield is 4%. 4. Interpretation: for income-focused investors, a higher dividend yield can be appealing. Advanced ratios. While the above ratios are fundamental, there are more advanced metrics like free cash flow yield, enterprise value to EBITDA, and the PEG ratio. These offer deeper insights and cater to seasoned investors. The importance of context. Remember, while ratios offer insights, they need context. Industry standards, historical data, and company-specific situations play a significant role. For instance, a high PE ratio in a growing tech company is more acceptable than in a mature utility company. Financial ratios are powerful tools, but they're just a piece of the puzzle. Always combine them with other research methods and stay updated on market conditions and industry trends. Happy investing!